Good morning, students. Let's start with next chapter of class 11th accountancy, that is accounting principles. So students, we have studied earlier that accounting is the only language through which businessmen convey its results to various interested parties. So theory base of accounting consists of principles, concepts, conventions, rules and guidelines developed over a period of time to bring uniformity and consistency to the process of accounting in order to enhance its utility to various users of accounting information. So let's take the meaning of accounting principles. Earlier, when accounting statements were largely needed by the proprietor only, these days these statements are needed by various parties who have vested interest in the business. So many stakeholders are there. So accounting statements disclose the profitability and solvency position of business to various parties. So it is therefore necessary that such statements should be prepared according to some standard language and set rules. So these rules are usually called as GAAP. So GAAP means generally accepted accounting principles. So these principles have been generally accepted by accountants all over the world, as they are providing general guidelines for preparing the accounting statements, and these principles are also bringing uniformity and consistency in the preparation of books of accounts. So next, there are so many basic accounting concepts are there. Let's discuss them about one by one. So firstly, concept is going concern concept. So under this concept, it is assumed that the business will continue to exist for a longer period in the future. The transactions are recorded in the business in the books. They are on assumptions that it is a continuing enterprise. It is on this concept that we record fixed asset at their original cost, and depreciation is charged on these assets without reference to their market value. And due to this principle, due to this going concern concept only, that outside parties also enter into a long term contracts with enterprise, like they are giving loans and purchase the debentures and shares of the enterprise. So next concept is consistency concept. So this concept states that accounting principles and methods should remain consistent from year to year. These should not be changed from year to year, because it enables the management to compare the profit and loss and balance sheet of the different periods, and management can also draw important conclusion from this comparison. So if a firm adopts different accounting principles in two different accounting periods, the profit of the current period will not be comparable with the profits of the preceding period. Like we can take one example. If a firm is choosing there are so many methods of depreciation, but if a firm is choosing one method like straight line method in this particular year, and next year it should be again consistent, like for the next year the method should remain fixed. It should not be changed from year to year. But the consistency concept should not be taken to the mean that it does not allow a firm to change the accounting methods according to the changed circumstances of the business. Otherwise, the accounting will become non-flexible and the improved techniques of accounting will not be used. So, next concept is accrual concept. In accrual basis is used for recording of transactions. So in accrual concept, revenue is recorded when sales are made or services are rendered. It is immaterial whether cash is received or not. Similarly, according to this concept, if we talk about expenses are also recorded in the accounting period only, in which they assist in the earning the revenues, whether the cash is paid for them or not. Thus, to ascertain the true profit and loss for a particular period and to show the true financial position of the enterprise at the end of the accounting period, all the expenses and incomes relating to that accounting period are recorded, whether actual cash has been paid or received or not. This is all about the accrual concept. So next concept is business entity concept. As per this concept, business is treated as unit separate and distinct from its owners or creators, managers and others. Or in other terms, we can also say like that, business is always considered as a distinct and separate from business he owns. Business unit have a completely separate books of accounts, and we have to record business transaction always from the firm's point of view, not from the point of view of the proprietor. And the always proprietor is treated as a creditor of the business to the extent of whatever the capital invested by the proprietor. So capital is treated as a liability of the firm because it is assumed that firm has borrowed funds from its own proprietors instead of borrowing it from some outside parties. And because of this separate entity concept only, the proprietor's belongings, all whatever the proprietor's personal assets, all they are kept separate from the accounts of the business entity. So separate legal entity, this principle is also applicable to all the forms of business organization like sole proprietor, partnership or a company. So next principle concept is money measurement concept. So this concept is very interesting, students. Under this concept, only those transactions and events will be recorded in the books of accounts which are capable of being expressed in terms of money. Okay. So usually in a business, transactions are taking place in a money, so that we will record. But it is always not possible that every transaction is taking place in a money form. There are so many events which are no doubt important for the business, but because they are not in a monetary form, that's why we cannot record them in a books of accounts. Like for example, in accountancy, we cannot record a quarrel between the production manager and sales manager. Similarly, a strike is there in the organization, that we also cannot record. Similarly, one more example, if a competitor has placed a better product in the market, that we also cannot record. So these facts or happenings cannot be expressed in money terms, thus they are not recorded in the books of accounts. So this is about the money measurement concept. Next is accounting period concept. So as per this concept, business is continued to run for indefinitely for a longer period of time. The true results of a business operation cannot be ascertained only when the business is completely shut down. But ascertainment of profit after a very long period will be of no use to the proprietor and managers and other investors, because it will be too late to take the corrective steps and actions at that time. So the users of financial statements always want to know the results of the business at a frequent intervals. Thus the entire life of the firm is divided into time intervals for the measurement of the profits of the business. So usually 12-month period is adopted for this purpose, and as per the income tax law, a business has to adopt a financial year beginning from 1st April to 31st March of the next year as its accounting period. So this is, students, about the accounting period concept. I hope it will be clear to you. Next concept is dual aspect concept. So dual aspect concept, as the name or meaning itself indicating dual means double. So according to this purpose, whenever any transaction will take place in a business, it will have double effect. Okay, every transaction affects at least two accounts. If one account is debited, any other account must be credited. So the system of recording transaction based on this principle is called the double entry system, and it is because of this concept that the two sides of the balance sheet are always equal. So our accounting equation is there that assets is always equal to liabilities plus capital. So every transaction must have dual aspect. One account is debiting, then other account must be credited. We can take one example here, like if a firm is purchasing furniture. Okay, so this is one transaction, but it will have dual effect in a business. What is coming in the business? Furniture is coming, so furniture account will be debited. But when the firm is purchasing business, definitely firm will have to pay cash, so cash will be going from the firm, so cash will be credited, right? So in this sense, one account is debited and another account is credited over here. So this is as per this concept. Students, let's discuss about the next concept, that is matching concept. So this concept is very important for correct determination of net profit. You know, students, that the main purpose of every business enterprise is to know about the profitability position at the end. So this concept is very important. As per this concept, while determining the net profits of the business operations, all costs which are applicable to revenue of the period should be charged against that revenue. So accordingly, for matching cost with revenue, first revenue should be recognized and then cost incurred for generating that revenue should be recognized. This we will follow while preparing our profit and loss account. Now the next concept is historical cost concept. So students, under this concept, we will firstly assume that assets will be recorded in the books of accounts at the price at which it was acquired. Okay, this cost becomes the basis of all subsequent accounting for the assets, right? Since the acquisition cost relates to the past, it refers to as a historical cost. So this cost is the basis of valuation of the assets in the financial statements. Okay, however, the cost concept, or we can also call it as a cost concept or historical cost concept, does not mean that asset will be continuously shown at their acquisition price only for as long as the business entity owns them. Their cost is systematically will be reduced from year to year by charging depreciation, and the assets are shown in the balance sheet always at the cost less depreciation. This will be done in the balance sheet as per the historical cost concept. So let's discuss, student, the next concept. And the next concept is given here is objectivity concept. So objectivity concept, this concept requires that accounting transactions should be recorded in an objective manner. While recording a transaction in the books of accounts, everything should be recorded in an objective manner, free from the personal bias of either management or from the accountant who is going to prepare the books of accounts. So it is only possible when each transaction is supported by the source documents and vouchers, such as, we can say, what are the various source documents? We can say like cash memos, invoices, sales bill, paying slip, agreements, etc. Let's take one example. When the goods are purchased for cash, so usually the transactions must be supported by the cash receipt for whatever the money has paid. And if the goods are purchased on credit, the transactions must be supported by a copy of invoice or any challan should be there. So every transaction in the business should be recorded in an objective manner, supported by a source document. Next concept is revenue recognition concept. So student, firstly let's discuss the meaning of revenue. We know the meaning of revenue. Revenue means the amount which is added to the capital as a result of business operation, right? So revenue is earned by sale of goods and services, whatever the business is providing to its customer. So concept of revenue recognition determines the time or the particular period in which the revenue is realized. Okay, so revenue is deemed to be realized when the title or the ownership of goods has been transferred to the purchaser and when he has legally become liable to pay the amount. It should be remembered that revenue recognition is not related with the receipt of cash. Okay, like let's take one example. If a firm is receiving order of goods on 1st January but supplying goods on 20th January and receiving cash on 1st April, so revenue will be deemed to have been earned on 20th January, on that day only when the goods has been delivered by the firm. Same in a case of incomes. Revenue in case of income such as rent, commission, interest, etc. is also recognized on time basis. Revenue incomes will be recognized on time basis. So time basis, let's see one example. If rent for a month of March is there but it received in the month of April, but it will be treated as a revenue for the month of March only, not for the next financial year. It will be considered for the for the particular that particular month only for which it belongs. Now students, come to the next conventions. Some of the conventions are there. So conventions may be defined as a custom or generally accepted practice which is adopted either by journal agreement or some common consent among the accountants. So usually there are 3 conventions are there. So let's discuss about them one by one. First one is convention of full disclosure. So this convention requires that all significant information relating to the economic affairs of the enterprise should be completely disclosed. Okay, so whatever the important information which is material to its users, like we can say proprietors and various investors, creditors, etc., that should be disclosed in a true and fair manner. So this principle is also very important because of Companies Act, because Companies Act also provides a pattern for a financial statement through which every firm, every company will prepare their balance sheet as well as the profit and loss accounts, and various items or facts which do not find place in accounting statements that must be presented, because it is a full disclosure. To in that case, firm have to present everything in a fair manner. So those things which cannot be finding place anywhere in the balance sheet, so they should be presented by the way of footnote. Right. So next convention we will take is convention of materiality. So convention of materiality, if we talk about this convention, it is just an exception to the convention of this full disclosure. Okay, so according to this convention, items having an insignificant effect, or you can say which are irrelevant, need not to be disclosed. Right? So these unimportant items are either left out or merged with some other items. Otherwise, what will happen? Accounting statements will be unnecessarily overburdened. Right? But while preparing books of accounts, it should be noted that what is material for one concern may be immaterial for another also. Okay, so due care must be taken by the accountant while recording the transaction. Okay, so nature of transaction should also be taken into consideration. So accountant should judge the importance of each transaction to determine its materiality. Next, students, we will discuss about the convention of conservatism. Very interesting and good principle. So according to this convention, all anticipated losses should be recorded in the books of accounts, but all anticipated or unrealized gains should be ignored. So conservatism is the policy of playing safe. You know, a business is associated with the risk. Okay, so to minimize or to overcome with this risk, everyone wants to play safe. So provision is made, always provision is made for all known liabilities and losses, even though the amount cannot be determined with certainty. Right? So likewise we can say, when there are different alternatives for recording a transaction, the one having least favorable immediate effect on profit or on capital, that should be followed by a particular organization. So some of the examples we can take over here, like closing stock is valued at always at a cost price or realizable value, whichever is less, because we are taking the losses, we are taking all the anticipated losses at present, we are recording them in the books of accounts, but we are ignoring whatever the unrealized gains that we are ignoring. Similarly, provision for doubtful debts is to be created in anticipation of actual bad debts. Right? So this is all about, students, about the basic accounting concepts. This we will do in this chapter in accounting principles. There we have discussed various concepts and various conventions. I hope this topic is clear to all of you. Thank you.